Hey guys, what's up? I'm Erin and welcome back to the channel. You know, the value of a dollar today is nothing like a dollar decades from now or even decades ago. So how do you plan your financial future when today's dollars and tomorrow's dollars are completely different worlds? Well, let's explore the crucial difference between today's purchasing power and your financial future. Picture an annual income of $80,000. For many, this represents a typical middle-class lifestyle. In fact, it's the median household income in the United States. Now picture a household income of $80,000 50 years from now. Without inflation data, we're kind of left with a lot of guesswork, but we can go back 50 years and see what that would have been. If someone had an income of $80,000 in 1974, that would be like having a $530,000 income in 2024. This speaks to the influence of a lifetime of inflation, because I think we can all agree that a $500,000 annual income is nothing but typical today. That puts you in the top 1% of household earners. So let's flip it around. What income in 1974 would be the equivalent of $80,000 today in 2024? The answer is about $12,000. That's a pretty stark difference. And I don't know about you, but it's kind of hard for me to conceptualize. It's kind of hard for me to picture what the price of groceries and housing and automobiles and clothing were when they're so drastically different than the world I know today. Of course, this is all due to inflation. Over time, the dollar loses value, meaning that a dollar in the future buys less than a dollar today buys. And generally, this happens at a gradual pace, a pace at which most of us don't even notice it's happening. Unless we run into years like 2021 or 2022, when inflation was happening at a really rapid rate, then it becomes far more noticeable. But even when inflation is happening at a subtle pace, it's still something we have to factor in because over time, it really adds up, as our example shows. Financial planning often looks decades ahead. Let's say you're 20 years old today. Well, that means you could easily have a 40-year investing time horizon before you step into retirement. But even then, if you retire in your 50s or in your 60s, you could have another 30 or 40 years of managing your finances. So whether you're at the start of your career, whether you're mid-career, or whether you're in retirement, understanding that the value of today's dollars needs to be adjusted is pinnacle to the success of your financial planning. And here's where we come to the distinction between today's dollars and future dollars. Converting future dollars into today's dollars when we run our financial projections makes them more tangible because future dollars are a little bit more abstract and hard to interpret at face value. One of the most popular things to do in personal finance is try to figure out what your future account balances might be. How many times have we all sat down in front of a compounding calculator to enter how much we're contributing on a monthly basis and guess what that might grow to over time? I feel like dozens doesn't even begin to answer this question. Let's say you're currently 30 years old and that you have $250,000 invested. Without adding any additional funds to this portfolio, what might this be worth if you're aiming to retire at the age of 65? Well, at this point, now we have a little bit of guesswork. It comes down to what rate of return are you comfortable using and what rate of inflation do you expect going forward? For the sake of being conservative, I'm going to use an 8% rate of return and assume a 3% rate of inflation. Now, I say this is conservative because historically speaking, the stock market has averaged a 10% rate of return, and that's prior to factoring in inflation. Once you factor in inflation, the real rate of return has been closer to 7 or 8%. So me using an 8% rate of return and then assuming a 3% rate of inflation is using a 5% real rate of return. Now, 100%, it's better to be more conservative than it is to be more aggressive when you're running your projections, because having a shortfall of money in retirement is far worse than having a surplus of money. And none of us know how the stock market is going to perform going forward. But at the end of the day, use a rate of return that you are comfortable with. So this 30-year-old with a $250,000 portfolio by the time they retire might have $3.7 million invested. Now, the first impression here is that's pretty incredible. What was a pretty modest amount grew to a pretty incredible sum. But keep in mind that this number is not inflation adjusted. What we're looking at is future dollars. If we interpret this $3.7 million as what $3.7 million would get us today, that's going to give us an inaccurate picture. So let's go ahead and factor in inflation. Bring our rate of return from 8% down to 5% and look at what it would be in terms of today's dollars. This shows us that the portfolio, in terms of today's dollars, would be closer to 1.4 million. And I feel like that helps to create a more realistic picture. So while that future balance might actually be closer to $3.7 million, in terms of purchasing power and what you'd be able to buy with it would be closer to $1.4 million in today's dollars. If you want a site or a calculator that can give you both of these responses, you can go to investor.gov. I'll put a link for it down below in the description box of this video. You can enter in your initial contribution, any monthly contributions, your time frame you anticipate being invested, as well as the rate of return you expect. And the key point here is an interest rate variance. So a rate of return that you would expect above or below the interest rate you entered. So in this case, when I enter a 5% interest rate with a 3% variance, we'll ultimately get an 8% rate of return, a 5% rate of return, as well as a 2% rate of return over this time frame. And I think it's really important to see the differences here on what these ultimate account balances would be and what type of income they could provide you. If you use what is considered a safe rate of withdrawal of 4% on a $3.7 million portfolio, that would give you an annual income of $148,000 a year. On a $1.4 million portfolio, that would give you about $56,000 a year. Both of these are accurate numbers. You could make the statement that both are true. It just depends on the context you're talking about them in. Because 30 years from now, you very well may need $148,000 a year to live a lifestyle that currently costs $56,000 a year to carry out. And knowing both of these numbers and how to interpret them is important. Now you can ask yourself, should I be running most of my financial projections in today's dollars or future dollars? But honestly, I think the best answer is to do both, because I think it can give you a more accurate picture. It helps to paint a picture of what your true account balances might be if you continue investing as you are today. But at the same time, knowing both numbers helps to create a more accurate picture of what your realistic spending power would be in terms of today's dollars. So what that account balance would look like would be the future dollars. This would be what you actually anticipate that balance to be several decades down the road. However, once you factor in inflation and get a realistic picture for today's dollars, I think that gives you a better concept of what kind of lifestyle you'll be able to have. You might notice in the example that I gave that I didn't use a monthly contribution amount to investments, and I did that deliberately because the whole point of this video is that it's based on today's dollars and future dollars, and I assume that over the course of your career, your income would grow and the amount you would contribute to investments would grow over time, and I couldn't find an online calculator that would accommodate that, so I made a spreadsheet for you to use. The way I've set up this spreadsheet is that savings is a percentage of income. When it comes to income, you can adjust the income growth you expect over the course of your career. You could expect, say, a 1% income growth on an annual basis. Maybe you expect 2%. You can put in whatever number you're comfortable with. But the theory here is that your income would likely be growing over time, and at the same time, you would want to grow how much you're contributing to savings and investments as your income grows. I've set it up so that you can adjust your initial investment, your income, your expected rate of income growth, your expected rate of return, the expected rate of inflation, and you can really personalize it to your situation. So I really hope you find it useful. The link for the spreadsheet is down below in the video's description box. And please note, when you open this link, you will be prompted to a screen that says Make a Copy. Please select Make a Copy. Once you select Make a Copy, you'll be able to open it and edit it on your own device. Planning for your future is about more than just chasing a big number. It's about what this number means in your life. Whether you're using future dollars or today's dollars, clarity is key. When you run your financial projections, do you use future dollars or do you use today's dollars? Maybe you use both. Share your thoughts in a comment down below. And while you're there, make sure to check out the video description box and check out that spreadsheet. Personalize it to your situation because I think it can be really helpful. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. See if I can get through this. One take. We were having a good start, and now the struggle begins. Probably never gonna happen. Annual income 50 years from now. Good pause. It's a great place to pause. And here, just thinking about what I want to say.